This is a full course step-by-step of how to value a stock. We're going to cover the 8 ways to value a stock, including DCF or discount cash flow method, and to work out the intrinsic value. Then we're going to cover a 12 step-by-step worked examples so you really know how to do it. That's going to include overvalued stocks, speculations, value traps, undervalued stocks. And at the end, we'll have 3 undervalued stocks you can check out now. That's going to include businesses like SpaceX, Tesla, Apple, Google, Spotify, Lululemon, Amazon, Aduro, Healius, ASML, Nvidia, and Netflix. Who am I? I'm an individual investor on the journey. I'm just 2,500 hours in over the last 7 years, and I'm sharing the lessons along the way. So here's my investing process. It's got 5 steps, and today we'll be really focused on the valuation. These are the guys I learned off. They did pretty well for themselves over just a little while. And so by following the breadcrumbs they've left behind, we can follow their footsteps and follow in some of that success. If you like the resources I wish I had when I first started, including the stock valuation calculator we're going to be using today, you can check that out with the link in the description. Otherwise, let's get into it. Let's value Nvidia. So we've got 7 relative ways that we can value the business, which we'll have a look at. And then we've got an absolute way, which is where we calculate the intrinsic value. So in covering these relative ones, we'll have an understanding for the limitations of these and why the DCF model or the intrinsic value is important for us. So we've got sales per share, which is also known as the price to sales. So we want to grab the total revenue, divide it by common shares outstanding. Where do we get that figure? On the income statement. So we can jump into our latest annual report for Nvidia. We want to have a closer look at the income statement, and there's our revenue, which is also the sales number for the latest year, 2026. So we plug that in. We've got to remember that that value was in millions. So we're going to add 6 zeros, and then we get a value of $8.92. Our current share price is actually 196 at the moment. And what that means is we're getting a multiple of 22 times that sales per share. Now, another technique is the price to earnings, which is also known as earnings per share as well. And what we want to do is we want to grab the net income. It's also on the income statement, and we go from being the top line of the business to the bottom line, as it's referred to. We've got a value of 120,067. So we plug that in, add a couple of, or 6 zeros after it because it's in millions. There are no preferred dividends, and our common shares are already there. We get a value of $4.96. With that, that means that shareholders are currently willing to pay a 40 times multiple on those earnings. Now we've also got book price to book, which is also known as book value per share or BVPS. Now, all that we need is the total equity. And equity is just total assets minus total liabilities. We can find that on the balance sheet. So let's go back to our annual report. Go and have a look for the balance sheet. We're looking for total assets and total liabilities if we wanted to calculate those. But luckily, we've already got the breakdown here. Total shareholders' equity, 157,293. Add our 6 zeros after it. We don't have any preferred equity. We get $6.49. So that means the shareholders willing to pay a 30 times multiple. Then we've also got the PEG ratio, which is price to earnings to growth. And so it tries to account for the fact that the business is growing as well. And people are usually willing to pay more for a business that is growing. So we've got our current share price, we've got our earnings, we've got our net income for the last 3 years. And so got that straight from the income statement. Now what I want to do is, all I'm doing is seeing how has this grown. So it's grown 145%. And over the last year, it's grown 65%. So find, the general trend, what's going on with these numbers. And just for this example, let's just plug in 65, even though we know that this growth rate is slowing down. So it's trending down, but we don't know where it's going to end up in the future. Now we end up with a PEG ratio of 0.61. Now, all this means is if it's below 1, just means it's potentially below value and it's with regards to the growth. And if it was actually more than 1, it'd be saying it's overvalued considering growth. Now, we've also got net working capital. And so this is a valuation method if a business is close to bankruptcy or it's looking really poor. We want to see if it's worth investing in terms of what the risk is for us. So if the business still has assets and it can pay off all its liabilities, which is current assets, everything that can be turned to cash within around 12 months, can it pay off all its liabilities? So things that it needs to pay in the next 12 months, plus all its debts and things like that in the future. We then get those two figures from the balance sheet and we get a value of $3. And because that's positive, that means, yes, this business can pay all its, using its current assets, it can pay off all its total liabilities. And so we get a 62 multiple. Now, free cash flow per share. This is a critical one because we're going to be getting into using this in our DCF model as well, our intrinsic value. But all it means is we're going to grab the operating cash flow, then minus capital expenditures. So where do we get those figures? On the cash flow statement. So let's jump back into the annual report. We've got net income that was on the income statement. And our first portion here is usually operating activities. At the bottom of that section, we'll get net cash provided by operating activities. So we get this 102,718. Now, that's one of the figures. Now, what we also need is those capital expenditures. And so we're looking around for things like this one, purchases related to property and equipment and intangible assets. So that is our capital expenses. Now, all we're going to do is pretty much get this number and subtract that. That's those two. We get them and we calculate that it's $3.99. So in free cash flow per share, people are willing to pay 49 times the multiple of that. Now, our last method out of these relative ones is a bit of a combination of mine, which is between Warren Buffett's owner earnings, which he created back in 1986, and that was pretty much to go and be used because most businesses didn't put out cash flow statements, but now we do have that. So we pretty much get operating cash flow, but then we want to minus the moat maintenance. And all that pretty much means is what's the cost the business has to continually put in to maintain its current position in the marketplace. So trying to get that number is a little bit difficult, especially if the business has part of it on the cash flow statement and then it also breaks it down in the notes to financial statements. Okay, and it breaks down what things are maintenance costs and what things are actually capital expenses to grow the business. And so that's why it gets important to read more into those financial statements and the rest of the annual report. Now, that little bit of extra effort is usually what's the difference between most investors, which get ordinary returns, and legendary investors. So for this purpose, I've just left it as it is, but usually that will vary and it will come into having a bit more of an understanding on the business and its industry as well. All right. So with those ones, we've got our 7 different methods. You can see our multiples, they all vary. But now what you need to do is you need to pick one of these methods or multiple of them and then compare these multiples with their competitors and try and see if they're undervalued or overvalued compared to their competitors. Now it's relative because we're just comparing different companies relatively. How do we get the actual value for the business? So let's go and have a look. Now, before looking at all these numbers, just worry about these ones in blue, first of all. So we filled those in and now we've got our base year free cash flow. So do you remember where we were on the cash flow statement and we just grabbed this number and we subtracted this? That's all we needed to do. That's what we've plugged in there. We've got our number of shares outstanding, and then we've got our current price per share. Now, with that base year free cash flow, that's for us to also find for the owner's cash as well. So we can adjust that a little bit more, either up or down, depending on what we find in those statements. Now, where the important part lies is in these red numbers, okay? So the whole point of doing a fundamental analysis and reading through the annual report is to be able to understand the business and understand what the potential outcomes for the business are. We want to find a business that's consistent and we have a pretty good understanding of where it's going in the future. Now, that gives us an understanding to be able to come up with some scenarios and have an understanding for what kind of growth rate are we going to expect for this business. So, probability distributions, and trying to get too fancy here, but just generally, we'd expect some form of range around these ideas. The stock might triple in the next year. What's the percentage that that's going to happen? It might be closer to 0.5%, 1%. So we're not going to worry too much about that. But in my just review that we're doing now, let's say that we come up and we've done the research and we think that it's going to be about a 10% growth rate over the next 10 years. So we can grab that figure and we can come up here and plug it into our growth rate. And we think, yep, over the next 10 years, it'll be roughly about that. Now, our discount rate is pretty much just saying, what do we think our zero risk return is going to be? Now, for myself and most other investors, being able to invest in an index fund for the next 20, 30, 40 years and expecting somewhere around that kind of mark is going to be pretty much the risk-free rate. Yep, we could be investing in T-bills and things like that, but the fact that the market can actually return 6% on average over a 100-year period is pretty good. Now, a growth rate into perpetuity. All that means is as time goes on, how much do I think this business is going to grow after that is first 10 years? And so if a business can have a good moat or a strong competitive advantage, it should be able to grow at around the pace of inflation, which for this example, we're just using 3%. Now, what we do here is all this calculation does is it grows our free cash flows at that 10% every year, and it's shown in this red column as it grows. And then as each year passes, that discount rate is used to decrease the amount that free cash flow that it made produced. So you can see that $1 today is worth less tomorrow, and in 10 years' time, that value is more reduced. So it's discounted at a higher rate. Now what this calculation does, it just grabs all these little green columns here and these ones, adds them back together to get this large number, and then we do that for another calculation to work out what it is into perpetuity. If that stock continues to grow at 3%, continued on, and we get a large number. Now, in short, what we do there is we just divide that large number by how many shares are outstanding at the moment, and we work out the difference between what the intrinsic value of the stock is and the current share price. So we get our intrinsic value per share of $255, and I want to work out what our margin of safety is. So at the moment, with the stock price at 196, it's less than the intrinsic value according to our calculation here. And that would be buying or paying 77 cents paid for $1 of value. which is a 23% discount. Now, that's one way. There's also another version, which is, let's have a look at the kind of the worst case. What if this business doesn't grow at all and it stays the same till the end of its days? The stock price would only be worth $133, and we would have overpaid 47% for it. So being able to understand the differences between how critical these growth rates are and inputting them will make you aware of what we're doing here. Okay, but for this example, that's how we go through and adjust those. Because Nvidia's growth rate is decreasing rapidly, it's had a big balloon up to, what was it, 145. 145%, down to 65%. We don't know what that growth rate's going to be over the next few years, let alone 10-year period. And it really depends on having a good understanding of this business, where it sits in the marketplace, and what the sectors that its customers are involved in is going. So that's why we do fundamental analysis and do a deep dive. All right, but Jack, can we value the most valuable and most expensive company in the world? Yes. So let's jump into, at this day, Apple has now taken over Nvidia. So let's have a look at the latest annual report. And so what we're going to have a look at is just our incomes, which kind of explains what's going on and why. So looking at our income statement for Apple, we've got our net sales. So for products, we can see our numbers have stayed pretty flat. They haven't grown much or at all over a 3-year period, but our net sales in services has grown. Now, the interesting part comes here. So what's the cost of these products? So the cost of the products is around, we can sell them for $300. We can got to pay $200. Now, what about the services? Well, we get paid $100. We only have to pay $25. So there's 75% gross margin on these services that they've got, which is huge. When we compare that to the 33-ish kind of percent that they're getting gross from the products, we can see that they're growing the most profitable arm of the business, which is these services. And I've been through the rest of the financials. It's not costing them a lot of money to actually grow that out and invest into it. So it's pretty much all gravy at the end of the day. So let's take that back to our valuation sheet. So in our discount cash flow model, we've got filled in the blue section. We've got what our cash flows are, our operating cash flow minus our capex. So let's have a look where we grab those figures from. We just want to find the cash flow statement, which is just here. And we want to grab this. So at the top third of the cash flow statement is the operating activities section. We get this number. So what can we see? Well, we can see that the figures have bounced around a bit, and we expect this to be a little bit lumpier than net income because businesses are incentivized to try and keep that net income as smooth as possible because it keeps the majority of investors really happy. And is that rational? No. It's because we're irrational, emotional beings. But at the end of the day, this is the numbers we're looking for. So we grab this number, and we also want to grab the property, plant, and equipment, and anything else that we kind of think is going to affect the business long term. But we can see that that number's been pretty consistent and hasn't had to grow much at all, and it's pretty flat around that. So come back to our calculator. We've already entered that stuff in. Now we want to look up numbers of shares outstanding. We have a look on Google or have a look through the annual report. But remember, Apple at the moment is spending the majority of their money that they're making, majority of that cash, is getting plowed into these repurchases of common stock. So they're making about, over 90 to $100 billion a year, and they're plowing the majority of that straight into buying their own stock back, which is a smart business decision for them. So hats off and fairy claps for good old Apple. Now, having a look at the business, those services arm, we had 85 billion, 96 billion, and 109 billion. Now, the growth rate of those is about 13, 14% across those 3 years. So we've got to come up with some value for this growth rate. Now, that hadn't consistently hit the free cash flow of the business, but over the long term, we can expect it to. So for me, looking the next 10 years ahead, I know Apple's gone from, nearly 15, 20% growth rates back 10 to 15 years ago, and it's slowly decreasing as it reaches the rest of its market. So I've come up with about 8% that I kind of feel that's right for me based on, the information that I've consumed. Will you get closer to an actual mark? Yep, definitely. But for this example, let's use that. We can use over the next 10 years, discount rate will keep the same at 6%. And yes, I believe that this business can continually raise its prices, even with strong competition, and make sure it stays in step with inflation. So we get a value of $358 per share, which is a little bit more than its current value. And that gives us that we're paying 95 cents for $1 of value, which is only a 5% discount. So is that pretty close to reality, or is it just the fact that I got pretty close with a reasonable guesstimate on what the growth rate might be? It might be that the rest of the market is feeling that that is what the expected growth rate and potential of this stock will be into the future. But that's pretty much where we get to. And we can see that over the last 5 years, we've got some significant times when the stock's been pretty low in terms of what investors were willing to pay for it. Had another dip earlier this year, and then it's been on the rise ever since. Now we're getting close to another annual report coming out for Apple. So there are quarterly and half-yearly results that have been coming out, which may update some of these figures and various things like that, which would be our expected growth rates and things. That's why it's important to also come back to these and update them in the future. Now, looking at the pessimistic case, if this business didn't grow at all, what would be the value? So we'd be talking about $224. And at the moment, we'd be paying 50% more than what we would in that scenario. And that is how to value Apple, at this point, the most valuable company in the world. So how do we go about valuing Google? So Google has something that's rather interesting in it. So let's have a look. So I've jumped on, just grabbed their annual report. So the latest one is 2025, the 10K. And we want to have a look at the cash flow statement. So this year it actually goes 23, 24, 25 from left to right. And the net cash provided by operating activities goes 101, 125, and 164. And through here, all the terms that we've got are fairly consistent. There's not too many things that jump up and down. So this net cash at the end of the day is increasing steadily. Now, that's a good sign. But let's have a look at what's happening. So acquisitions, net of cash acquired, and purchases of intangible assets, and purchases of property and equipment. So property and equipment is our main one here, where it goes from 32 billion, 52 billion, and 91 billion. So that's more than tripled in that time. And then we've also got this net cash provided by operating activities. It hasn't more than tripled in that time. So what we've got is their investments in property and equipment is quickly outpacing the amount of cash that they've got. Now, this was from last year. I've just had a look on the top of their website, just a little update here saying that this is from previously. So Alphabet announces proposed 80 billion equity capital raise. So what they're trying to do is they're trying to get additional funds to be able to build out this extra infrastructure faster than their cash that they're generating from the main business. So that just means it's going to dilute other shareholders, and they're hoping that this extra capital and the race to build this infrastructure is going to pay off down the track. So that's the latest that we've got from here. But how do we account for this, knowing that our cash flow or free cash flow as we calculate it here is decreasing? And so what do we do long term? So what I wanted to have a look at was we need to work out what this, I guess, the revenues, things that are affecting it, are coming through at. And what I found was, since this is increasing about 23% and then 31% across the years, that net cash flow, the Google Cloud Services revenue grew 36%. So that accounted for about 15 billion across that period. And that continues on. And then we've got a bit of a breakdown on revenues. So let's have a look at that, page 33. So just down here is where it explains those details for which arms of the business. Then it goes in and it breaks it down here. So what does that entail? So Google Services includes all these bits and pieces. So Google Search, which has the majority of it, YouTube ads, Google Network, that's our Google advertising portion of it, the business, and then Google subscriptions, platforms and devices is included in that. Now Google Cloud is down here, accounts for about 43 billion and it's grown up to 58. So that's where that 15 billion and the 36% growth has come from. These other sections here are a bit smaller at about 15%. So that's those main arms. Does go in and explain a little bit more on a bit later, but we can have a bit more certainty around those values. Now, what about this infrastructure build? We need to have a good understanding of what that's going, like what's happening within the business. So on page 39, we've got capital expenditures. This is the one that we want to have a look at. So our capital investments in property and equipment consist primarily of following major categories: technical infrastructure, which consists of our investments in servers and network equipment, data center land, and building construction and improvements; office facilities, ground up development projects, and building improvements. So it just says during those years 24 to 25, we spent 52 billion, 91 billion on capital expenditures, respectively. In 2026, we expect to significantly increase, relative to 2025, our investment in our technical infrastructure, including servers and network equipment and data centers. All right. So over time, those assets will be depreciated. But at this stage, we can see that these guys are plowing a lot of their money into these servers, network equipment, data centers, and trying to get in on the rush to the AI. I guess build out the AI infrastructure and then be able to implement that in their products and services. So because the cash flows from and the benefits from this, I guess, new wave of infrastructure and capital expenditures, we don't know how profitable the business will be in the future and how much these investments are going to pay off. Now, the management team is pretty rational in terms of how they've ran Google so far to grow it to where it is today. Now, if we'd completed a full deep dive of the business, we'd be able to have a much better understanding of how much we actually trust the business and the management team and things like that. But overall, the cash flows or free cash flows that are being generated from the business has stayed pretty much the same. So around that $70 billion a year, once taking into account, the paying for that property, plant, equipment and that build out. Now, knowing that the business is invested a further $80 billion that it's trying to acquire or has acquired from shareholders, we need to plan that into how that all fits with what's the risk profile for the business and things like that. Now comes the good part. I've already got that base year cash flow. Let's just grab that net cash flow minus that capital expenditure of 90 billion. We end up with 73. We've got our number of shares outstanding. And then we've got our current price per share, which is just looked online. It's 332 at the moment. Now I've got to come up with a growth rate and the years of growth so that we're looking forward. So probably we'll just leave it at 10 years. Now, the revenues of the business are growing more than 15%. Some parts of the business in the software section is growing at 30%, but we don't have full clarity and transparency on how much money in the future these AI developments are going to have and bring value to the business by bringing value to its customers. We can assume that it's going to have a positive effect, but how much? And that's why we need to use our judgment for. Now, without going too far into the weeds and doing a full deep dive on it, let's just use a number that sounds reasonable. So over time, we can expect these capital expenditures to come to a normal kind of standard, and that won't be outpacing its free cash flow. It should get to the stage where it's not asking for any more cash from outside investors to invest in the business. It's great to see that the business hasn't invested in a lot of debt to increase these developments. It's using shareholders. So just taking that into account, knowing that these revenues have increased like over 20%, a rate of about 15% growth rate over the next 10 years sounds kind of reasonable. Now, look, we don't really know what's going to happen with AI, and other business competitors may influence on Google, but picking that number out kind of seems fairly reasonable at this stage, at least for me. Now, over that period, that pretty much gets us to an intrinsic value per share based on that of $606. And that gives us a margin of safety and a discount of 50 or 45%. So what does that mean? So at this stage, because most of the money within the business is being reinvested back within it, there's a lot of unknowns, and a few investors and things like that aren't valuing Google at its potential to grow. Now, it all relies on what the thesis is for AI, and that's why valuation requires having a really good understanding of the business. And this is just a guess at this stage. Is it reasonable and responsible? I kind of think so. But having a look at these details in depth and having a look at where the competition may come in the future for Google, and whether Google is large enough to be able to acquire competitors and be able to bolt those products and services onto their existing business and customer base, is one of its huge advantages and moat around the business. All right, now let's try and value Tesla. So Tesla's another interesting case because things aren't traveling in the right direction. So looking at the income statement, we've got revenues here, and it goes 23, 24, 25. We can see that revenue is actually decreasing. So in their sales, they're going from 78 down to 72 billion, down to 65 billion. So that's not a good trend. And what about energy generation and storage? So they've got a couple other divisions. And then they also have services and other. So you can see that it's grown from 6 to 10 to 12, and then 8 to 10 to 12 billion as well. So we can see that there's some growth within the business that's kind of masking these automotive sales that have dropped. And what's that come out to the net income? Well, it has been decreasing as well. But this is going to be a pretty fudged figure because there's a lot of non-cash charges that get influenced. So let's have a look at the cash flows. So once all those adjustments come out, our net cash provided by operating activities is actually fairly flat. So we've got 13 to about 15, and then a teeny bit less at like $14.7 billion. Our purchases of property and equipment and things like that is pretty flat as well. So they haven't been building out and expanding over these 3 years. Looks like they've maintained costs in those investments, etc. So we will get a value of about $6 billion in free cash flow once subtracting those ones. And we've got a number of shares outstanding of 3.9 and a current share price of 307. Now, knowing that we've got automotive sales decreasing and we've got energy and services are growing, but the margins on them aren't crash hot. It's not like our review of Google, where part of the business was growing substantially more with great margins, or just like Apple. This business has high costs relative to their sales. So for instance, 65 versus their cost of 56. So there's only, 10 billion that they're getting from a 65 billion outlay. And then similarly for the services business, 12.5 outlay only, for a cost of 11.5, which are only making 1 billion, and similar for the energy generation. So it's not like there's a huge, very profitable portion of the business that's already there within the business. Sure, they've got other ideas for what to do in the future and things like that with robo-taxis, etc. But at this stage, looking at the business, it doesn't look very healthy or enticing. So coming up with some form of valuation for the business. So do I think that the management team that Elon has put together can grow the business? Yes. I know that the automotive industry is cyclical, but there is also much more competition around electric vehicles, just by literally having a look around and seeing all the new brands that have got in on the action. And so the initial wave of momentum that Tesla ran on may have bumped out, and now there's a lot more competition in that space. We also don't see much of a moat around those financials, so it is a bit tricky to be able to value this one. There's a lot more risk involved because there's a lot more unknowns. But let's say, for instance, we just assume that the business can at least grow over the next 10 years at 6% per year, which they've actually stayed flat for the last 3 years. Just to keep that in mind, that this business is way overvalued. So we get the intrinsic value per share to be about $69. It's currently $307. So that means that we're paying $4.40 for $1 of value. So this is an example of a business that is way overvalued. It's not even close to reality. And what it means is a lot of investors are putting a lot of weight on the future prospects of the business. They're hoping that the business will be able to make huge profits in the future. But those huge profits in the future, remember, they need to be discounted back to today. And especially if they've paid $307, it might take a decade or two for that stock to come back to that stage once the business has matured and got through this, I guess, very speculative phase in the stock's, growth. So you might buy it at 307. It might be very volatile, going up and down for a long time. You might be able to ride a couple of buys and sells. But at the end of the day, in 10, 20 years' time, this stock will not have delivered the value that you want to get from it. And that is a valuation of Tesla and an example of a very overvalued stock at the moment. Now let's try and value Amazon stock. So Amazon is another interesting case because it's got something where it's not actually growing its free cash flow. It looks like it's actually shrinking. Now let's have a look. So we've got these cash flows statement. We want to have a look at that, and we want to get our net operating cash. You can see that value here across the year 2023, 2024, 2025. And then we want to have a look at this. Purchases of property and equipment. We've got 52, 82, 131. So we can see it's growing as well as the cash that the business is generating. And the difference between these two numbers is pretty small. So it looks like the business is plowing almost like 80% of its cash straight into property and equipment to try and grow the business. Now, fun fact, Amazon has actually been doing this on repeat every year for the last over 20 years, almost 30 years now. And it seems to have worked so far. But how do we value a business when those cash flows, the free cash flow of the business is this number minus this? So it starts to get a little bit small. So let's have a look. Here we've got the net cash flow coming in. We can see that's increased 36% and 20% over those 2 years. And then we can see that we've got our costs here, which have increased 57% and then 59%. And then our free cash flow is 32 billion, 33 billion, and then 8 billion in the most recent year. So we can see that there's been definitely a race from the business to try and spend more money on building out the infrastructure and spending. Now, with a business like this and having done a bit more of a deep dive on Amazon and having a good understanding of the moat and the management team and how they're performing, this is one where we know it has a very strong moat. Pricing power is very strong. It has a really strong brand as well. And what we want to do is think about now and then way, way out into the future. Like take it to as far as it can be. So Amazon will continue to grow this value, its net cash, and its revenues as it has been doing until it reaches the entire marketplace that it can reach. So every corner of the world pretty much, which has access to the internet. That's what they're aiming for. Now, we need to think, how much further can the investments in terms of expanding the business go? Because at one stage, the business is going to reach the entirety of the world. It won't then need to continue to invest to expand, but it will need to be able to invest to maintain all its equipment and infrastructure. So having a look back here, and that's what we call that maintenance. That's what we want to try and come up with. Now, I've had a look through and I couldn't really find anything that breaks down the difference between the two in the reports. And so what we can do under those circumstances, we can just make some assumptions, and they need to be smart assumptions. So having a look here at these two figures where we get this kind of baseline. So back in 23 and 24, where we've got the same kind of figure and same kind of ratio between the two being maintained. Now, for me, taking that kind of figure in today, so in 2026, as our normalized kind of free cash flow, knowing that the business is spending significantly more on building out the future and trying to grow faster and faster. So I think this kind of number is quite conservative, knowing that eventually there'll be a significant amount of this cash, probably more than that, will be able to go back into the business either through repurchasing shares or buying or paying dividends, and make its way somehow back to shareholders, in short. So we've got this partially filled out, but we've got our base year free cash flow that I've come up with of 33 billion. We've got a number of shares outstanding, and the current share price is 230. Now, what do we think for the growth rate? So we've got a growth rate on our actual net cash of 36 and then 20%. So knowing that this business has pretty much grown it at 20% per annum pretty much from 1997, I'd be safe to say, for the meantime, of a 15%. And doing more research on it, you'll get closer with these values to what you're comfortable with and what your understanding of the future of the business will be. Now, having a look, that just gives us a value of $307, which is 75 cents paid for $1 of value at the moment with a 25% discount. So that gives us a bit of an indication about how we can try and value a business which is spending the majority of it on growing the business. It can make it quite difficult to understand what that maintenance just to maintain the business is going to be, especially when it doesn't make that clear throughout the life of the business. Because at some stage, the business won't need to pay for growth, but that could be 20, 30 years ahead. So that's a good example of that. And that is how to value Amazon. Now let's value ASML. ASML it operates in a monopoly. And what it builds is the machines that actually produce the microchips at a scale and at a size that's at this stage the smallest and most reliable that we can go. So because their machines are very in need, they have effectively the monopoly over the system and they should have some pretty good margins. So let's have a sticky beat. Go find the financials. And like we've done before, we just want to have a sticky beak at the net sales. We can see that from 23 to 24 to 25, that it's growing. It's fairly steady. But what a better sign is the net service and field option sales are growing and almost doubling over that period as well, which is a really good sign. So they've got the machines in the hands of their customers. And now they're growing that service stream of the business, because it looks like when you've got that kind of high specialized kind of skill sets and knowledge, it pays to be able to look after that equipment and service it appropriately, especially when you're paying large sums of money on them. So let's go and have a look at the cash flow statement. Equity continued, and cash flows. So our net income comes out. You can see that it's a little bit lumpy, but it has increased in the most recent year. Net cash provided by operating activities. Nice. So we can see that this value has increased, and it is a little bit lumpy. Like there are a few items in here that have come out that have impacted that. So between different years, this contract assets and liabilities has taken away from one year and then been additive on the other years. And so I would expect this number to be a bit closer to reality. All right, so we've got that. Now we need the purchases of property, plant, and equipment. So what does it need to maintain its current position? So we can see that it actually has decreased and into the year 2025. So for me, looking at the slight growth that the business has had and the services division, it doesn't need much to be able to build out that services part of the business, because it's purely people, tools and equipment, and that's about it. They're not needing to build entire factories and things like that and specialized know-how. So purchase of plant, property and equipment, I'm going to pick a number of 2 billion. Just for me, like as a long-term kind of piece that, and the starting point, that's more of a kind of the average between these ones. Now, the impact that this initial cash flow has on the valuation is very large. So we want to make sure that we are conservative as much as possible with the starting assumptions. So let's go back. I've already plugged that in here. So minus the 2 billion, and that is our base year free cash flow, 10.6. Now the number of shares outstanding is there, and our current share price is 1,388. Now, the actual sales is growing around 10% a year, and there's actually some really strong services growth. Now, with some competitors coming into the market and the research that I've done thus far, it does look like the business is pretty much going to have a monopoly, at least for the foreseeable future and over the next 10 years. Other businesses that are looking into it are going to need to start from scratch pretty much. They might get the intellectual property rights to some technology and have some, really good science around it. But there's a difference between getting it to that stage and then commercializing it and then getting the consistent repeatability of results for customers. These things are pumping out thousands and upon thousands of these every year. They need to be right. Otherwise, I tell you what, the customers are not going to be happy and they're not going to purchase any more of their equipment. They'll go straight back to these guys. So what is our expected kind of growth rate? Well, this is where having that big global picture around where ASML sits in terms of the global chip market, and then also where it sits in terms of, are we going to expect overall microchip supply to, or demand to increase over time? So having some of those bits and pieces will help shore up, a bit more certainty around what that growth rate is. But for me, let's just pick out a number that's a bit less than its current sales trajectory. So 8%, still with our remaining assumptions there, discount rate, growth rate to perpetuity. And what we end up with is intrinsic value per share of $1,476, which is at a margin of safety of 6% discount. So with where the current share price is at the moment, as of today, that is a pretty good indication that it's probably roughly around where its value would be. It doesn't appear to be way off, way undervalued, or extremely overvalued. It seems to be pretty close to around the money. Now, that is how we analyze a ASML and a business that has a very strong monopoly on its market. Doesn't mean that it's going to have absolutely huge, unrestrained growth rates, but what it does mean is that cash that's coming into the business is very high compared to its revenues and things like that. All right. How do we value an IPO? So let's have a look at SpaceX, because it was the largest initial public offering ever, at least for now. So what we do is exactly what we have been doing so far. Now, this is the prospectus. Every business that comes out and does an initial public offering is required to provide this. Really, it's just an annual report that's about 2 to 3 times as long. But we can skip all that and go past all this beautiful pictures just to try to entice us and get us off our mission, get us excited for investing in the next amazing thing, only to realize, well, we'll have to wait and see. So index to financial statements is what we're after. And let's have a look. So most businesses that are having an initial public offering, what they're doing is they're trying to raise money, and they want to raise money from shareholders. Now, that is usually for one thing. They want to grow the company. There are a couple of other options when they do it. They also may want to realize the value of the business by selling a portion of another business off. So for instance, Chrysler or Fiat Chrysler selling their subsidiary at the time, Ferrari, and Ferrari became its own company. Now, in this scenario, SpaceX is its own business entity in its own right, and it's now coming onto the scene, onto the public markets. Now it wants money so it can grow more quickly and invest that into, obviously, its next plans for its development. So whether that be new plant, equipment, etc., or just establishing a base in Mars and Elon getting his own private rocket, and then he leaves with a couple of $1 billion or $1 trillion. We don't know. But at this stage, it should be written in here what the business plans to do with that money. But that is yet to come to pass. So always have a look at the time that the IPO is on and have a look for, put that into account, what their businesses are actually going to do with that money, but it can take years for that to come to fruition. Now, we want to be able to have a look at the business and see if it's got some potential. Now, property, plant, and equipment, we're looking at the balance sheet here. It's 21 billion and then to 42 billion. So it is investing very rapidly in building out its assets. And we would expect that for a business that, at the top of mind, they're building rocket bases. They're then building the rockets. And so they need somewhere for them to fly from. Then they need the actual rockets to fly. And then they need everything that goes along with that to support it. So manufacturing facilities and things like that. So the other main item here is goodwill. So they've done some purchases of other businesses or things like that. And they've done that at a premium to their market value or their book value at the time, which means that becomes a non-cash charge on the business. That can disappear at any time if the business then does a accounting test, so we don't really worry about that. What is its liabilities? So we want to make sure the business isn't loaded up with a bunch of debt, and we'd be a bit worried if a business had come in with a heap of debt and trying to go for an initial public offering. Now, it could effectively refinance its business or recapitalize it by selling more those shares to the public market and then wiping out its debt, which is sometimes what they do during bankruptcy and liquidations of businesses. Now, let's just jump straight in. We want to see what's this business actually making? So at this stage, and this is in millions again, so this business isn't just coming from nothing. It's got made 10 billion in 2023, 14 in 24, and 18 billion in 25. So its growth rate is very high for revenue. Now, cost of that revenue is quite high. Total costs and expenses is high as well. So it's actually running at a loss along these years. But the aim of the business at this stage is to focus and funnel most of that money back into growth. So net loss, 5 billion last year. Would we expect that? Yes. For this time in the business's development, it's in the growth phase. And so it hasn't mastered its market. It's also trying to grow rapidly to maintain and continue to build on its current market position, which is number one. Now let's look at the cash flow statement. What do we got? So we've got our income comes out. We've got depreciation, amortization. We've got deferred revenue, and we've got net cash. So if we have a look here, the actual net cash in the business is growing. So 4.5 billion, 5.7, 6.7 billion. So that's a good sign to see. These are majority of just balancing the books from year to year, and then as well as non-cash charges within the business. So it's good to see that the cash is consistently growing. Now, where is the business spending that money and the rest of previous investors' money as well? So the private owners of that. So purchases of property, plant, and equipment. So everything's getting plowed into it at the moment. 4.4 billion, up to 11 billion, then up to 20 billion. So we can see here that the business is purely punching it all into building out all these assets for the business. Proceeds from debt and other financing obligations. So they've grabbed that. And then in the previous year, they got that. So they're going to have to be paying that. And then they've also got repayments of other debt and then proceeds from issuances of capital stock. So during these years, they've sold some to private buyers before this year in 2026, going out to the public markets and bringing the company to market. All right. So knowing that and knowing those growth rates, let's have a think. So the business, if we account for these, free cash flow, that calculation is based on this number minus this. And what we can see is free cash flow is negative because 6 minus 20 is a negative number. Now, but the net cash position is growing. And then our revenues are growing as well. So what is our revenue rate? It's between 35 and 33%. The net cash is growing at 28 and then 17. So, roughly around 20% net cash. We're going to expect for some of those things to be increasing in price, maybe some efficiencies with these new assets, but they'll also have to increase depreciation. So we've got all that happening. Now, all this money the business is going to be reinvesting that it pretty much gets from this initial public offering. But how much of that and what the business has been spending on these assets is actually long-term going to be what it's paying? Because we need our free cash flow number. But what is it actually going to be? Because over time, this majority of this is going to be for growth, not just maintenance of the rockets, maintaining the facilities, keeping them up to date and looking after them. This is also just build out, buying equipment, buying the land, etc. So we need to think, what is our starting point going to be? So roughly, most really competitive and newer businesses can usually get around 50 to 60% is on maintenance costs out of that split. So I want to try and keep that for our starting point. So I've gone and grabbed our 6785, which is this number here. And I've just times that by the remaining 40% to get what our actual free cash flow would be if this business wasn't plowing so much into growing the business. Because we need some form of starting point that's rational. Now, and that 50 to 60% can vary a lot. So lots of older businesses that are very capital intensive. Some years it could be up to like 90% just on maintaining the business, and 10% of its capital or capex goes to growth. Now, shares outstanding, we've added that in, and at the time of the IPO, what we would do is just put in the current share price that the business is putting forward on it. So it should say how many dollars per share each one's going to be. Now, on the front cover as well, that will usually come with this, which is a little quick summary of what the breakdown of it's going to be. And then it also has, where was it? Might have seen it on the other one, but it gave a little breakdown on, it's not shown here. So on the website for SpaceX, I had to get this from the SECs. The rest of the report comes out a bit jumbled up, but what it does come up is per share price. And so the people underwriting and actually do the work in the background to market and provide the capital, manage all the funds coming in, funnel that to the business, hold it on the business's behalf, and all that sort of stuff that goes on in the background. All these businesses here, they all kind of work together as these joint book running managers. And so they all got a slice of the action. So out of the, say, 700, I think it was around 700 billion that was raised, these guys ended up making $500 million, so 500 million between them, just for bringing it to market and doing that transaction. So remember, they're like car dealers. They get a little slice of the cut and it's going to come out. Do we see the value for that if we buy at the initial public offering? No. It's like when you walk the car straight out, it loses a bit of its value. Now, the aim of these guys during an IPO is to get the most money up front for that stock. After the IPO, the business obviously needs to try and maintain its image and look after that share price, so it can't go too drastically too high. But it does want to try and maximize the amount of money that it's getting injected into the business for each share. They don't want to give equity of the business away for nothing. So with that in mind, we can probably expect that at the initial public offering, most public offerings, the price dips afterwards. It could be within 6 to 12 months of it, and then the price will then have to be brought back up by the market as the business has proven itself. Now, what's the starting value for these going to be? We've got net cash, and then we've got revenue growth. So over time, that revenue will come down and hit the bottom line. But at this stage, because we're talking about cash and cash flow, I'm going to be picking out a kind of reasonable number for that. And somewhere between 20 to 25 at this stage for a rapidly growing business, and one that's been quite well run up to this stage, we'd want to put in. So let's have a look at what a 25% growth rate over the next 10 years would give us for a value. So being on the high end of my estimates, we get $85 per share, which is, we're effectively paying 36% more. So we're paying $1.36, sorry, paid for $1 of value. So without exceptional news coming out of the business and even more rapid growth than that, we're not being compensated for it. Now, if that was a 20% growth rate, just so you can see the bounds of it and how much this growth rate can impact it, it would be worth $55 if the growth rate was less. Now that shows that you could pay double what it's actually worth, and it would take a very long time for this business to be able to effectively pay you back for what your purchase was. If in 10 years' time you pay double what it was actually worth and the business underperforms, you're exposed and you've just lost your money, which could have been invested in a better investment at this time. So that gives you a bit of a rundown on that. Now, if the business thinks that it's going to outperform a 25% for the next 10 years, that's entirely plausible situation. But with the information that I've got and my starting assumption around what a free cash flow reasonably would be if this business wasn't ploughing it all into growth as well, that's where I would be. All right. And that is how we value a IPO, especially SpaceX, the largest IPO in history to date. Now let's value a business that is pre-revenue. So at this stage, this business isn't making much at all. Now that makes it pretty much a very speculative investment. So Aduro Clean Technologies, we're going to do exactly the same thing we have been doing. Grab the annual report and we want to have a look at what they've got going on. So cash and cash equivalents, Non-current assets, we would expect for a business like this to be increasing their assets. And yet, property and equipment has grown by 25, or 3 to 4. And what else? Liabilities, share capital has increased. And let's have a look at the income statement. So this business, what are we talking in? It's expressed in Canadian dollars, so it's not in thousands, or millions. So what that means is in 2024, this business made $337,000, and in 2025, it made $231,000. So not much at all. So, and the costs where it's investing its time, so it's grown from 3 million up to 5.4 million in research and development. And then it's also grown in general and admin. So from $4 to $6 million. So we obviously want the business spending money where it's going to see benefits, which is in this research and development. We don't really want to see this growing. Other things that we wouldn't want to see is the management team getting paid exorbitant amounts or getting incentivized and payments already when the business hasn't actually made a profit. Let's have a look at the cash flow statement. Our net loss for the year, 7.4 million in 2024 and 12.1 in the latest year. Now, share-based compensation expense. So that is just money that's been set to the side, hasn't actually been paid to the management team. What else have we got? We get cash used in operating activities of 5.2 and 8.9. So you can think of this as well as, investing activities down here as pretty much like the cash burn of the business. So how fast is it chewing through all this money? So financing activities is back to front. So usually that's below the investing activities. Now they're issuing shares. So they've issued more shares, and they've issued more shares this year as well. And then they've used that to keep them afloat this year for that net operating loss. So what else have we got? We've got property and equipment acquired. So they're growing that at a steady rate. And that's pretty much it. So this business, at this stage, you got to try and think it's got negative cash flow. It's got negative income or negative net income. And the equipment it's going to continue to plow into. Now, how do you value a business that hasn't proven that it can meet its customers' requirements and get paid by them, and the amount of money that we're exchanging for those services or products is what the business needs to make a profit to begin with? Because we could come out and sell lemonade for $2 a jug, but it could cost us $3 to, just in costs, just to do that. But if the customer's not willing to pay more than $2 for it, and then we go out of business because of it, that's a reality that could lay ahead for this business. Now, what about if the business does reach profitability? But what about if the market for it, no one really cares? Or there's another technology that comes along in the next 5 to 10 years, which would be on this business's time frame to be able to come to market and start to grow. What will it look like then? So this business has lots of different hurdles that it needs to jump over before we get to the stage where it's making a profit and it's making cash flow within the business. It's not just constantly growing. So we need to, and even then, the business needs to have a moat around it. So having the intellectual property for some technology isn't enough. It would need to either continue to invest there, or what does the actual landscape look like in 5 to 10 years' time? So there's all these unknowns and risks that could potentially happen, and lots of different outcomes. So exactly that. There's not really any revenue, negative cash flow, and the cash burn requires more shares to be issued. Now, I've seen a business do this for over 20 years, making little to no revenue, probably about the same, as much as they're even less than they're actually paying the CEO of the business in just a salary. It's making negative cash flow, and every year they never go out of business or go bankrupt because they don't have loans and debt. But what they do is they raise capital nearly every year. And what that's done is it's actually diluted all the original shareholders in the business from what they owned, and it's reduced their value just by 70% just by dilution alone. Now, the actual value of that business was very high, or the price of it, but over time, because it was such a speculation, they've realized, or majority of people have realized, that it's worthless. The business has then decided to change its name multiple times to rebrand itself and cover up the fact that it hasn't actually done anything worth talking about in over 20 years. Just to come along and fool some more silly investors willing to put millions of their own dollars into a worthless investment. So, if we understand that though, what does that mean for this one? Well, surely there has to be a way that we can value it. Yes, there is. So we can come up with ways to try and justify what it's currently priced at. So at this stage, the stock is valued or priced by the market at $13 a share. There's around 34 million, I think it was between 34 and 35 million shares outstanding. Now, because it doesn't have base year cash flow, we want to make a couple of assumptions. So with this, the business, like last year, made $200,000. Okay, that's not cash, that's before everything. But let's just say in a magical world that this business made $200,000 in cash flow. Over the next 10 years, what would the growth rate of this business need to be for it to reach the current valuation? Drum roll. It'd be over 55% growth year on year. Now, to put that in perspective, that's over a double every 2 years. Over a double. Now, that would be faster than Amazon's growth rate and other extremely fast businesses. That would be astronomical and just wouldn't be the case. Now, what about if this business made itself and, in the next 12 months or next 2 years, say if it managed to get $3 million, got a large contract or a couple of contracts in place, and so that cash was coming through the business, what would the actual rate need to be? All right. So we'd be talking if and when the business gets to having at least $3 million in free cash flow, and the rate was maintained at 20% a year growth of that cash flow, that would be a realistic number for this. But this business at this stage, I think everyone's hanging out waiting to hear big news about it, and we still haven't seen any of these kind of figures come through. So that would be kind of the realistic scenario, to have a bit of a play with a calculator and see what would need to go right for this business to be worth and, I guess, valued or priced by the market at that. There's a lot of things that need to go right for that to occur and for this to occur. And you need to have one of the best management teams in the world to be able to bring this to market and achieve that rate. Okay? And that is how I would try to value a business that has near to no revenue or pre-revenue. It's got negative cash flow and it's burning through cash as well. It's a matter of having a play and figuring out what would need to go right for the business to be valued or priced at that amount. Now let's analyze a business that appears to be an amazing value purchase at the time, but it is actually a value trap. So let's have a look at this company. So Healius, it's an Australian company that looks after pathology, testing and things like that. So I've already cracked open the annual report. We're going to have a look at the income statement. And we can see that from 2024 to 2025, it's gone from 1.2 billion to 1.34 billion. So some good growth there and fairly steady. And we've got some other bits and pieces that come out here. And it's making a loss for the year. And it looks pretty lumpy. So it's made 100, it's gone from over $500 million last year that it lost to 151 million this year. And having a look, what are the large numbers that come through here? We've got consumables, their costs, other expenses, depreciation, and then this big one here, impairment of goodwill. So we know that goodwill is a non-cash charge. So this doesn't affect the cash flow of the business. And what it is it's an accounting requirement to for if a part of a business has been purchased by this company in the past and it was bought at a certain value, then over time that company needs to do tests on it pretty much every year as part of accounting requirements. And if the business unit isn't performing to these certain requirements, then the business needs to account for that on the income statement as these non-cash charges. So that looks like it might be interesting to have a look at, because we can see here, oh, look, they've also had profit for the year from discontinued operations. So they must have sold part of a business off as well. So it's a bit hard to see what's going on here. Let's have a look at the balance sheet. And so our current assets has gone from 300 to 251 million, but overall total assets is decreased a little bit from 2.9 billion down to 1.7. And where's the main differences here? So goodwill. So that write-off that we had before of 600 million from the previous year, and then another pretty much decrease this year, which was 495, has now come off the assets, and so it's decreasing that. Also got a couple of other smaller ones in here as well, but right of use assets is decreased if that portion of the business was sold off, and lease liabilities and interest bearing liabilities. So that's good. Looks like that's come off the books. And at this stage, the total liabilities is smaller than total assets, which is good. Now let's have a sticky beak at the cash flow statement. So we've got our receipts, payments to suppliers, and net cash provided by operating activities. Actually comes out as a positive. So they've got gone from 266 up to 285 million. And then we've got proceeds from sale of a business, $795 million. And then we've got our property, plant and equipment. Now there's nothing else really that they need to invest in here. So our free cash flow would be this 285 minus 54, and we end up with 231. So we can see our growth rates in terms of revenue, it's going up at 5%, and our free cash flow, our net cash is going up by 7%. and we end up with a free cash flow figure of 231 million. So our current shares outstanding is there. Our current stock price is 38 cents. So this stock has decreased 90% over the last 5 years. So that's a huge difference. And so looking at the information we've got so far, it's decreased in value. It's an unloved stock. At the moment, it's going further and further down, and there's these non-cash charges sitting on the business, like almost like $500,000 worth, which means that the net income is showing at a loss, which is, because of these non-cash charges. So we're starting to think, well, this is looking like a pretty good opportunity to look into. So if we plug in here and we think, say, even if the business grows at 5%, we would come with an intrinsic value per share of $12.90, which means we're paying 3 cents paid for $1 of value. So that's a 97% discount according to our calculations here. And even if the business didn't grow at all, it would still be worth $10.64, which is still a 96% discount. Man, this is awesome. Like, we should be looking into it and just buy now pretty much before other people realize it. But there's something else going on. So let's go back and have a look. So this is the reason why we can't just trust one set of figures, and especially even free cash flow, which is just net cash provided by operating minus our property, plant, and equipment, or our CapEx. It's because payment of lease liabilities. So we just did our calculation for free cash flow and we got 231 million. Now, we've got interest paid on lease and liabilities, proceeds from borrowings, repayment of borrowings. Things like this is usually where the business will be reinvesting part of the free cash flow it's got and back into the business. Or it might be paying off some debts and things like that. But this payment of lease borrowings is pretty much something that is required every single year. And usually these are actually coming out up here in terms of an expense, an operational expense. But for a little funny reason, it's down here. And so pretty much what does that do to our free cash flow? It pretty much wipes it out entirely. So we go from 231 down to about 12. And that isn't really consistent across the years. So these lease liabilities, they're payments that still need to be made. And so that pretty much takes out the entire cash flow, and we end up back at where the net income was. If we have a closer look here, we got 495 and 603 with the non-cash charge of impairment of goodwill. What would happen if we took that off? Well, we'd be back on the good side and we'd have a profit for this year. However, they've also just sold the business for 795 million, which has bumped that up from what it should have been. So really that comes us back down to square. And we've also got some other bits and pieces that come out over that time as well. So really this business doesn't have any free cash flow. That makes it very difficult to try and value this business, because is it going to make any cash in the future? We don't know. So just taking the current value of the business, so 268 million is what it's currently priced at and what people think it's worth paying for. So we can do, just like we did one of our other examples, we can have a look at what needs to be right for that price that it currently is to make sense. And so it's just another frame to see if things are worth looking into further. So we know that we had our free cash flow Our operational one was 268 minus our 54, we get to 231 million. Now we take away our 200 and is this where it is? Yep. 219 from that. And we're left with, say, about 12 million in free cash, plus give or take a few other figures here. But in order for this valuation to work out, we've still kind of got that growth rate where we know that revenues are going to be kind of hopefully tracking along and staying flat at that 5%. We've still got our fixed current price per share of 38 cents, and we've still got our number of shares outstanding. So to get a valuation that makes sense, they're pricing the business with a free cash of $7 million, which is a huge difference compared to if we just use the free cash flow equation. And that is and even if the business doesn't grow at all, we're still overpaying for it at 38 cents. So even if it only produced $7 million every year into the end of time pretty much, it's still being overpaid. So there's really a big reliance on this business growing to be able to turn that around and be seen at producing some actual money. Even if we put 12 here, which it is going up and down across the years, and there are additional expenses, it's showing a bit of a discount. But for something that's teetering very close to, or it's just maintaining and not profitable at all, there is going to be a significant amount of time before it reaches enough of a stable growth pattern that it may end up having to sell additional shares off. So this is what we would call a bit of a value trap. We obviously want to try and catch falling knives as skillfully as possible. And is this a knife that's worth catching? And at this stage, probably not. There's definitely not a 97% discount to it. And that's why we need the importance of looking into the figures with a closer level of detail and doing that deep dive to be able to understand the numbers and understand the business as well. And that is how you watch out for a value trap. Now let's value Lululemon. So over its entire life as a publicly traded company, it's gone from humble beginnings and risen to the top, and over the last pretty much 5 years has been on a downward trend. So yeah, 70% down from, the start of that period, but it's gone up to 500, and $510 at one of its peaks. So it has gone down significantly more than 70% over that time if you'd bought around during a bit of this hype. So I heard recently that Michael Burry had purchased some Lululemon, and I decided to have a sticky beak at it. So I've jumped into the annual report as usual, grabbed the latest one, jumped into the income statement. So from 2024 to 25 to 26, the revenue has grown from 9.6 billion to 10.6 to 11.1. So it's got some steady growth there, even if it's, appears to be slowing down a bit from, a 1 billion difference up to half a billion. And then we've also got here net income, 1.5 billion, 1.8, 1.5. So still pumping out a fair bit of net income. We can see here that the costs of goods sold has risen as well. And our gross profit has pretty much stayed fairly flat. So with more units and products being sold, the overall gross profit hasn't really increased. So reasonable kind of growth, nothing crazy here. A bit of fluctuation in the net income, which usually that can mean that investors either the business isn't meeting expectations, and that can provide some of that downward pressure on the price because less people believe it will be making more money and worth more in the future. They're pricing it in to have less growth or negative growth. All right, let's have a look at the cash flow statement. So we've got our net income. We've got some adjustments here that come into it. So just looking out for anything that's out of the ordinary. And we've got inventories, which fluctuates quite a bit. Prepaid and receivable income taxes. So there's a big hit for this year. We've still got some fluctuations here. Other accounts payable and things like that we'd expect. Current and non-current income fluctuates through the years by, quite a lot. And then we get down to the bottom and we've got net cash provided by operating activities. So 2.3 or 2.29, 2.27 billion, and then 1.6. So we can see that our net cash provided by operations has decreased a fair whack this year. We can see that there's here it's negative, here it's negative. We've got accounts receivable hit for this year, which hasn't in the previous years. We've got accrued liabilities and other, which has been positive by almost 200 million in previous years, down to 100, and a couple of bits and pieces like that, but nothing too crazy. There's not like just one large one-off. And we'd expect for a business that has lots of, smaller units, that we would expect to see some challenges with maintaining inventories, accounts payable, and things like that. But we can see that our free cash flow is decreased a fair whack. Now, were these fluctuated during these years because it was favourable? Potentially. So we got an almost extra 200 grand there. Kind of wipes it out, but there's another 200 grand here and things like that. So we expect this variation. It's not as neat and tidy as the income statement. But what about our purchase of property and equipment? So you can see it's been fairly steady, 651 million, 689 and 680. So it's increased a bit and decreased in the most recent year, just down with that, the free cash flow that they've had. So just looking at that, getting our free cash flow figure, we're talking about, in the most recent year, just under $1 billion. And then in these years, over $1 billion. Closer to 1.5 pretty much, or 1.5 billion. So we can see, what are we going to assume and come up with our smart estimates here? Well, for me, I think I needed to have a look back at previous years. So I went back and had a look at what's our net incomes that are coming out, just looking at the cash flow statement. We can see that from 2022, it was 975 million up to 854, and then it overlaps with our 2024 of 1.5. So when we get down to the bottom here, what are our net cash flows? So 966 million and 1.38. You can see that during these years, they pretty much just increased purchase of property and equipment and tried to keep that same ratio with the amount of free cash like in most recent years, but it was kind of backflipped back here. Now, what have they been doing with this cash? So across these years, majority of it has gone into repurchase of common stock, which is usually a good sign. And some's obviously gone out to management for the stock-based compensation payments and things like that. There's no dividend or anything, so that's usually a good sign. Now, what am I going to come up with for that value? So just using the most recent year, 2025, and subtracting that 680 million for property, plant and equipment, we get this figure. What I've done here is the revenues for the last 3 years. plug those in. Sorry, revenues here. Sorry, the net cash from operations here, we can see it's decreased by 30%. And we've got here some kind of, it's not really a good trend for the most recent year. So what I'm going to put in for the growth rate. So even if we assume zero growth, we get 44% or 44 cents paid for $1 of value of the business. And the price that they're saying intrinsic value per share is 266 against our 118. So even during these ups and downs back in 2023, we can see that the business is still produced cash, is still gone up and down. And it just means that this stock, even if it continues to grow in revenues by 5%, and that would be on the rosy side of estimates, in time, if that continues to flow down into the cash flow of the business, and we do see that 5% growth there, the business would be, I guess, we're paying 37 cents paid for $1 of value. Now, what does that mean for the current share price? So having a look, it has positive net cash or net income. So it does have a price to earnings ratio. The price to earnings is 9.6. So this business is being valued by the marketplace as having negative growth. People are expecting this business to shrink and decrease its either revenue, its net income, and that free cash flow by a significant amount over time. Now it really comes down to picking out and analysing the business and doing that deep dive to be able to come up with some really good and have more insight around what the growth prospects of the business are. If it is going to decline over time, by how much? And then what are the options for it as well? So is it going to be part of merging into another business? Is it going to be acquired and at a premium and things like that? So there is options for this business, and it does appear that it is undervalued at this stage, but it's all about going in and testing these assumptions, having a look at how the business is growing in different markets and understanding its customer. You really need to know if the business has mastered it or not. And that is how we try and analyze and value a company that is undervalued. So let's have a look at another stock which is undervalued. So at this stage, Netflix, it's decreased in value in price over the last 12 months. And we can see that it's had a pretty strong increase up from coming back out of COVID and then back down over the last 12 months. So do the same thing again. We want to find the latest annual report. We want to have a look through the income statement, balance sheet, and cash flow statement. So revenues, 33 billion, 39 billion, 45 billion. So strong growth there. And what about the cost of that revenue? So the cost has pretty much been the same. So we've almost got we've had 50% growth over a 3-year period, but we've had nowhere near that amount of growth in the cost of revenue. So that means that the margins are increasing, which is really good. We want to see that. Some of these other things, so sales and marketing, technology, and general admin have increased as well. But it's really good to see that the cost of those revenues isn't growing at the same pace as the revenues. Now let's have a look at the cash flows. We can see our net income, the bottom line of the business was 5.4, 8.7 billion, and 11 billion. Coming out at the bottom, we've got net cash provided by operating activities, 7.2, 7.3 billion, and 10.1. So that is really strong. Now, what are the purchases of property and equipment? So our CapEx, we can see that's increasing. It's a lot less than the net cash though, so that's really good. We can see that they're increasing that a lot. So it's doubled over that 2-year or 3-year period. And we'd like to see that because it's expanding. Part of their moat is making sure they've got the equipment, making sure they are timely. There's no like delays in terms of getting transferring the information. So videos, content, and things like that. That's part of their platform and delivering it to their customers. What else have they been doing with that money? So they've got some things here with purchase of investments, things like that. But the majority of their money's been going back into repurchases of common stock. And so that would be a really good time to be going and buying this stock back in recently because it is undervalued. We're about to go through that. So for the revenue, we've got 16% growth pretty much year on year. That gives us that pretty much 50% over 3. Then we've got our net income, which has grown at 61% between 2 years and then to 26. Then we've got our free cash flow. So free cash flow was our net cash provided by operating activities, subtract this number. So that gets us closer to 9 and pretty much just under 7. So that's 6. So 6.9, 6.9 and 9.4 billion. You can see that in the recent year, we've had a 37% increase just in free cash flow. And what did they do? They increased their purchase of equipment to expand that CapEx, but they also, the majority of it, so over 90%, went to repurchasing stock. So we plug that free cash flow back in there. Already checked out, we've got around that number of shares outstanding, knowing that that's decreasing over the time with this share repurchasing. We've got a current share price at the moment of $71. So let's come up with a bit of a number for this growth rate. So we've got revenues increasing by 16%, and it's pretty consistent. We've got net income and net cash, which has increased a fair whack. So we could come up with 10%, which is lower than what we've got here for these expectations of like reality, not just future expectations from the business. And we can see that with that growth rate, the price intrinsic value would be $144, which is a 51% discount compared to what its current price is. So that's pretty good, getting it for half price. Now, let's assume that the business doesn't grow at all. If the business just stayed the same from now until forever, it would pretty much be close to where it's being valued by the market. Now, that seems a bit silly to me because I'm a user of Netflix, the family is, and there's so much stuff on it that it's always interesting and always new things, and they're still investing in purchasing content rights and different things like that. So they've been able to look after their margins. I still think this business is going to grow, and more than zero. And probably a very small percentage that I would think that Netflix would decrease in value. I think their ability to create content that people actually want to watch, not brain rot, from the perspective of just AI slop and other content like that. So I'm pretty sure even if it was at a 5% increase over this time, we're still talking about a 22% discount. And so how can this be? So a lot of people talk about a efficient market theory. And if we have a look, like what's going on at the moment is the business is being valued by this stock market, and other share, like people that have either bought shares, etc. Some people trade them and things like that. They expected this stock to meet certain expectations, which could be they expected 15% growth rate year on year. But now the business is down rating that expectation or guidance on the next quarter. They might be only expecting a 12% revenue growth for that period. Now, that not meeting, and it's not meeting their own expectations, it's not meeting the people that are trying to, or the analysts that are trying to put numbers on what the future is going to be. And when they're publicized and those figures get given to funds and different things like that, they're expecting a certain amount. And when that doesn't happen, they just sell. And so that means there's a lot of downward pressure and a lot more shares coming onto the market than people that actually want to buy. So we get a supply and demand dynamic. So all that means is there's a good opportunity for people that think differently, but you also need to think correctly. And so by doing your homework, analyzing the business and doing the fundamental analysis of it, you can find these opportunities and then be able to check them as well. That is how you review and find undervalued businesses, especially a large business like Netflix. Now let's have a look at another potentially undervalued stock, Spotify. So over this period, price has gone up significantly, and over the last 12 months, it's decreased about 25%. Now it's starting to travel a bit sideways over the last 6-month period, pretty much. So this could be an interesting stock to have a look at. So we're going to grab out the annual report and have a sticky beak at that. So our income statement of operations, we've got, what are we talking in millions? So 13 billion euro, 15 billion euro, and 17 billion euro. Cost to revenue is pretty small, and it hasn't increased at the rate that the revenue has, which is good. It means this business is becoming more profitable with the more revenue it brings in. So what's our net income at the end of the day? 2.2 billion. Sorry, we had negative 500 million. The following year it was up to 1.1 billion and then 2.2 billion. So that's a pretty strong net income increase. All right. Where else we got? So let's have a quick look at the balance sheet. Just make sure there's no grenades here waiting to go off. Got goodwill, long-term investments. We've got a total assets of 15 billion compared to total liabilities of 6. That's awesome. Anything else outstanding here? Any large debts? Majority of it, which is going to cause an issue. Nope. Non-current. Where's current liabilities? Current liabilities at the bottom. So we've got current liabilities of 6 billion compared to current assets of 10. So we should be all right there. Definitely a lot of coverage. So that's good. The business is in a really good, just quick check of the balance sheet. Now what about cash flows? So bring out that net income. Let's have a sticky beak. Oh yeah. We've got net cash from operating activities, 680 million, 2.3 billion euro and 2.9 billion euro. Now, where does the business need to reinvest? Combinations, deferred consideration, purchases of property and equipment. Now, is there anything else that needs to? Nope. So it's just plant equipment. Wow. 6, 17, and 61. 61 compared to 2,933 is a very small number. So we don't even really need to worry about that. It's almost like a rounding error at how little the business needs to reinvest in either hard assets or infrastructure and things like that. So what's the business actually done with all this cash that is just blowing out everywhere? Well, repurchase of ordinary shares. So I did a little bit of that in the last year. Exercise of options, come back in, and then payment of taxes and whatnot. But the key difference has been they've bought more short-term investments, and sale of maturities of short-term investments is just the balance there. So there's like, yeah, about 1,700 that's just been slapped into that one. And in short, what that's done is it's just increased their current cash position. They haven't thrown that money back out. They're held onto it at some stage for something in the future. All right, let's go and have a look at this. So we got our revenue increasing 18%, 10%. We've got a turnaround from net income of a negative, so we won't worry about that, but we've still got a significant increase. So just that 10% rise in net rev was able to drop pretty much straight to the bottom line of the business. So that is a really good business to own. Very low assets, and it's all margin. And what else we got? Free cash flow. So we had that poor year and then still a 27% increase. So what does that mean for our business? So if this business only grew at 5% in terms of its cash flow, we're not talking about revenues, because we've just seen how much of that revenue increase is actually dropping to cash flow at the end of the day. So this is an interesting one, because we can't just rely on, if majority of investors are looking at the revenue of the business and the revenue slowing, they might be missing the fact that the actual amount of cash this business is generating is huge. And so the fact that this might go up 10%, we see 94% increase in the amount that gets to the bottom line. What is that going to mean for our free cash flow going forward? So a growth rate of 5% on that free cash flow over the next 10 years means that it's at a 12% discount. For me, I'm a current user of Spotify and I love music. And so having something where I don't need to buy a new couple of CDs every year, or go onto iTunes and have to buy it and then it can only be on that, like I can have it on the app, have it on my phone, on the computer, everything, without having to update it. It just streams straight to it. So it makes it pretty easy for me, and I really enjoy the interface. So for me, if that's my personal experience around it. We've still got revenues increasing. I still think a 5 to 10% increase in revenue is more than likely, and that we're going to see those margins of the business continue to hold, showing a very strong business with a strong moat around it. And with that 10%, that gives us a 44% discount to its current value. So it would price it at $895, which if we have a look on here, it was getting up to that value and probably would have continued on if it hadn't, I guess, overrun with the price going past investors' expectations and things like that. So this is another analysis of an undervalued company and what you could be looking for. Thanks for sticking around, legend. If you like this video, you're probably going to like this playlist. It's a how-to of stock investing with all the videos that I've put together for that. And if not, check out this video because YouTube thinks you'll like it. Cheers.